Valutrades, Forex, CFDs, and commodities. One of the most important parts of technical analysis in trading is chart patterns. Perhaps the most reliable and easiest to trade of these are triangles and pennants. Before we look at triangles and pennants, we would like to remind you that CFDs and FX are leveraged products and that your capital is at risk. These products may not be suitable for all investors, and we encourage you to read the risk warning on the Valutrades website. These shapes all represent the battle between buyers and sellers and look like compression of price like a giant spring. Eventually, the pressure compressing the spring will give out and price will move. There are 6 major patterns that we can look for. Bullish and bearish pennants are continuation patterns and generally leave in the same direction that they entered. Descending and ascending triangles are again compression, but they are up against horizontal lines of support or resistance. They could leave in either direction. Falling and rising wedges are a pause and compression in the middle of a long trend and are a very reliable pattern to trade. These work on any time frame, and here we have a 4-hour chart on gold. Using our MT4 trendline graphic tool, we can draw a lower trend line with obvious higher lows, and then draw an upper trend line with lower highs. We have drawn a pennant with price compressing during 1.5 months. Suddenly, price breaks through the lower trend line and crashes for almost 5 days. This was a bearish pennant, and as we can see, it exited the pennant in the same direction that it entered. Here we have what is known as a descending triangle. The difference between this and a pennant is that one edge is a clear line of support. We can see that price tried to break through 4 times, and finally on the 5th attempt, the pressure from sellers was too much, and we had a serious breakout to the downside. Keep in mind that with this type of pattern, price action could go either way. For example, here we have an ascending triangle. Price tried to break through resistance 4 times, but buyers could not succeed even after all this compression. This ascending triangle could also be considered a pennant on this Euro-Pound 15-minute chart, and either way, price broke through the lower trend line and dropped to a previous level of support. A few days later, a news event drove price up and another pattern formed, the falling wedge. The falling wedge is a bullish continuation pattern, and this is exactly what happened as price continued to rise. These patterns work on any asset. Here is a pennant on the 4-hour chart for the S&P 500. Keep in mind that these are not always perfect patterns, but as long as you can see lower highs and higher lows, you will have price compression. In this case, it was true as well, as the stock market crashed for 3 days after that. On the way back up, it formed this double bottom, which held true to form. We will talk about double bottoms in another video. Then it formed an ascending triangle, and when price broke through this lower trend line, the S&P fell again. You could actually consider this pattern as a rising wedge. Either way, it did its job. Let's review the types. Bullish and bearish pennants are continuation patterns and generally leave in the same direction that they entered. Descending and ascending triangles are again compression, but they are up against horizontal lines of support or resistance. They could leave in either direction. Falling and rising wedges are also a pause and compression in the middle of a longer trend, and are a very reliable pattern to trade. That's all for now. Happy trading with Valutrades. We will be back with more soon.